Okay, welcome back, ladies and gentlemen. In this evening's discussion, I'm going to talk a little bit about financial statements and financial ratio analysis. Now, admittedly, this is an area that can get fairly dry and fairly deep fairly quickly. So what I've done is broken up each one of these topics into 4 separate videos. So you can kind of take a little breather and go grab a drink or something and come back to the video for the next section. So in the first video, we're going to talk a little bit about the background, the topic of generally accepted accounting principles, very, very briefly, as well as some of the regulatory organizations that are involved in financial statements. And then we're going to tackle the income statement up front, which is known by a few different names, but basically talks about the economic profitability of an organization over a period of time. The second video, we're going to talk about the balance sheet, which, as we say here on the screen, presents a snapshot of the financial position of an organization, that is the assets and liabilities as well as owner's equity at a specific point in time. Video 3, I'm going to talk about the statement of cash flows, or basically the sources and uses of cash that an organization experiences over a period of time. And last but not least, in video 4, I'm going to talk about ratio analysis and the DuPont equation that really helps us now basically standardize financial reporting across multiple time periods. As you can understand, the numbers on both numerators and denominators shift and adjust over time. So we've got to be able to reduce them to like terms to be able to understand, are we getting better or are we getting worse from a financial perspective. So, but before we go any further, we need to understand that even though we're going to talk about each one of the financial statements kind of in isolation, they are very much connected. We just kind of have a very kind of basic graphic here that kind of walks and talks through how the financial statements interrelate, going from the balance sheet at the end of 2016, and we see how specific elements, and these are not exclusive by any means, but some of the elements we see depicted on the screen here translate, like for the sake of just for the sake of demonstration, we see cash at the top of the 2016 balance sheet progressing from the top here over into the statement of cash flows at the beginning amount, and then we'll see the ending cash balance at the end of this particular reporting year being translated over to the 2017 end of year balance sheet. Likewise, we see retained earnings down here at the balance sheet at the end of 16 being transmitted over to the statement of retained earnings for the 2016-2017 time frame, and then we see retained earnings as of the end of 2017 being reflected on the balance sheet. Likewise, the income statement, the revenues less expenses, that net income also gets brought down to the net income line on any sort of restatement of retained earnings, and then of course which gets translated over to the balance sheet that we just described. So key takeaway point here is, even though again we're talking about these by themselves, they're very much kind of like different strands of the same spider web, because we're really talking about the organization as a whole. So also important to talk about, or at least understand, that there are a lot of individuals, a lot of entities that are very interested in what organizations do from a financial perspective. I mean, we often think about investing in an organization, which is important in its own right. However, there's multiple parties involved that really are there to not only protect the consumer from an investment standpoint, but also ensure as much transparency as possible for creditors, for vendors, for state and federal regulatory agencies. So a lot of thought and a lot of individuals are involved with the policy making side of things when we start talking about the regulations and standards involved with financial statements, financial statement development, and financial statement reporting. Now, the big dog in the house, quite honestly, is the Securities and Exchange Commission, particularly as we're talking about for-profit entities. Okay, so the SEC, of course, has the legal authority, and this really was born out of, they were actually created out of the Great Depression and the stock market crash in the late 20s, but really are there to be kind of the watchdogs and ensure that what is being reported to the public is as fair and clear and accurate as possible. However, as you might understand, the SEC, even though they're the watchdog, they are very much reliant on individual industry experts. So in the case of healthcare, the SEC relies on, of course, the FASB, or the Financial Accounting Standards Board, that oversees all industries. But also specifically from our industry, we're talking about the Principles and Practices Board of HFMA. Honestly, the American Hospital Association gets involved, and several of our other large, basically proponency groups get involved as well. So American Medical Association gets involved, MGMA, of course, American College of Healthcare Executives, so on and so forth. So very much a team effort, as you can understand. In many cases, it might be a little bit contentious, because where one side of a particular industry wins, another side might lose. But we're all involved. We're all in the same industry, and certainly a lot of players involved. Now, also important to understand that, and from what you might recall from your accounting courses in the past, there are two different forms of accounting. Cash accounting, obviously, is the simplest, easiest methodology that basically just records and recognizes a cash transaction at the point at which it takes place. Okay, so very much will mimic your tax statements that are reportable to the IRS. However, it can oftentimes give a very chaotic, if not somewhat disingenuous picture of the overall financial status of an organization. For example, I've worked very recently with a local clinic who does or who performs a lot of personal injury sort of cases. In those instances, those cash flows, when a case is actually settled in court, those cash flows come every 2 or 3 years, or perhaps after a 2 or 3 year delay from when the treatment of the patients involved actually starts. So even though the costs are incurred, let's say in 2015, the clinic may not see payment for those until 2016, 2017, or even possibly 2018. So you can understand that in that particular sense, whenever the cash flows are recognized and they come in the door, they get a check from whatever payout or settlement, that's a great thing. However, all the expense associated with that particular delivery of care, or those multiple episodes of care, has happened in the past, sometimes months or years in the past. So that mismatch can give a very false impression to any lender, vendor, potential investor, whatever the case may be, in how well that organization is progressing financially. Now, the flip side of that, and the requirement that we often see imposed by CMS, by the SEC, certainly for-profit organizations, is the use of accrual accounting, or what we can basically consider the primary touchstone of generally accepted accounting principles. Okay, and with accrual accounting, it's often considered to be more complicated, but really provides us a better picture of the true economic status of a business, because we cannot recognize a revenue per se until, let me say this a different way. Basically, the expenses have to be matched up with the revenues as they come in the door. Okay, so whenever we receive a revenue, we also have to then recognize what expenses, to the maximum extent possible, have gone into actually generating that revenue. So it very much helps us to smooth out and gain better clarity in terms of, okay, did we really make money? Or perhaps we, in the case of our first example under cash accounting, maybe the organization expended more money than what they actually collected in the end. And what we've got to be able to do is reconcile that much more quickly, much more effectively, and much more transparently, so that any potential vendor, creditor, whatever, can actually understand, hey, are these folks actually coming out positive? Are they actually making money? Are they going to be in business, next month, next year? Or are they really in trouble, and therefore might change or alter my decision with respect to either lending, granting credit, selling on credit, whatever the case may be. So as we talk about GAAP, really All we're really interested in, though, with GAAP is when we report to the public. Okay, so oftentimes you will see a lot of financial reports generated by an organization that do not leave the organization. They're purely internal. They're basically used by the organization for internal decision making. Those statements do not need to adhere to GAAP. Okay, but anytime an organization is reporting to the public, disclosing to the public, basically making their financial status known, the predominant, I would say, I don't know the percentage exactly, but I would say we're in the high 90s percentage at least that organizations have to adhere to GAAP reporting for consistency purposes as we look across organizations, as well as for, like all the reasons I mentioned before, for the purposes of transparency and a basic level of understanding of how that organization is doing over time. Okay, so with all that in mind, and again, I'm not interested in making anybody an accountant today, but we have to realize that before we can even talk about generating an externally facing income statement, balance sheet, statement of cash flows, one, we have to realize there are a lot of players involved in terms of how these things have to look. Second, we have to really recognize some of the basic tenets of how transactions are recorded and maintain consistency. Again, if hospital A is recording transactions completely differently and recognizing revenue or expenses completely different from hospital B, there's no way that we can conceivably reconcile any sort of comparison between the two organizations, at least from a financial standpoint. So that's what GAAP does. That's what the SEC is after. That's what the AICPA is after. That's what FASB is after. We want to have comparability and fairness, frankly, in our markets so that any organization or any external entity, any individual can pick these things up and really understand them at a more granular level than we might otherwise see if it was purely up to the organization to decide. So anyway, with all that in mind, want to start with the income statement. Okay, now income statement, in my humble opinion, is probably the most important financial statement, especially if we're looking at any sort of short-term understanding of whether an organization is really doing well or not. Okay, because the income statement is, again, going to tell us basically how well or how much or how little the organization made from a net income standpoint during the last reporting period. Now that might be the last quarter or the last year, but really, as that middle bullet here speaks to, it answers the question of whether or not the organization is making money based on the business operations that is undertaken over that period of time. Okay. Now, don't be confused. You'll often see this statement called by other names, such as a statement of operation, the statement of activities. You might see some others beyond that, but in the end, typically you're going to see the same three financial statements reported. There might be a couple others that get added on, but you will more often than not always see the income statement, the balance sheet, and some variation or derivation of a statement of cash flows. Okay, so from a very basic standpoint, we're talking about the results of operations over a period of time. Okay, and really, from a purely basic standpoint, we're talking about revenues over expenses. If revenues exceed expenses, we have, thanks be to God, net income or profitability, right? When expenses exceed revenues, we have the direct opposite of that, or a net loss. Okay. Now, there are several nuances within both the revenue side and the expense line or lines that are important to understand. Okay. Now, revenues, of course, are any sort of cash inflows to the organization. Okay. Now, the revenues can actually come from multiple different sources, even within a hospital. The obvious one, of course, is patient service revenue, right? Where we're actually receiving payment for the patient services that we provide to the local community. Now, we will often see the term net versus gross. Okay, gross is all the money that you might charge for, may not actually receive, but might actually be the large pot, if you will. But we talk about things on a net basis because really net is what we actually receive from a cash flow standpoint. Okay, so net is, and we're going to talk about in a slide or two, talks about how we actually get down to, from that gross large pot of money, if you will, what actually gets siphoned away before we get down to the money that we can turn around and actually use to cover our expenses. Okay. Now, it's also important to understand that we're going to have patient service revenue. Okay. Now, patient service revenue, of course, is going to be different than any sort of revenue we get from, let's say, the dining facility or a parking structure or the gift shop or investments that we have external to the organization. Okay. And it's important that we understand what money we get from our core business line versus what we get from other sources of revenue. Okay. It's not unheard of for those other sources of revenue to actually exceed patient service revenue, which then begs the question of what business are we actually in. Okay. Now, also important to note that especially as we progress more and more through into value-based purchasing, population-based health, at-risk contracting, what have you, that those sorts of arrangements are going to show up differently in our financial statements, and indeed already are. Okay, so whenever we have, for example, a capitated payment structure where we're getting a per member per month or per member per year rate for a beneficiary, we're actually going to recognize that revenue a little bit differently because that comes in as premium revenue that's oftentimes paid in advance before we actually incur any cost in terms of services provided. Okay, so as I mentioned earlier, in reporting revenues, oftentimes you're going to see in healthcare organizations several different lines that are reductions from revenue that gives us eventually our net patient service revenue. First and foremost, we see this term discounts, where although we might have a charge master or basically a list of all the prices at basically full cost for all of our services that we provide throughout the organization, and of course that's based on not only our clinical capabilities internally, the equipment we have, as well as our provider population, but it's also going to be heavily dictated, of course, by our payer mix. Okay, so those discounts, we're basically price takers with respect to Medicaid, Medicare, but when we start talking about the commercial insurers, depending on the market power within the market, whether or not you're affiliated with a chain, if you will, or a larger healthcare organization, if there's more market clout, that is certainly going to have some sort of influence on the percent discounts that we see off of our full cost or our full menu price. Okay. Second thing you're going to see many times is charity care. Of course, this is incredibly important to not-for-profits, okay, because we need to be able to show or demonstrate that we're providing charitable care to meet our 501c3 or not-for-profit mission. So we've got to be able to record how much charity care that is actually delivered to the local population. Okay, and we'll get into the nuances of this at some other time. But charity care is recorded at cost, not at full charge pricing. So that gives again external entities, especially at the state or federal level, an understanding of the charity care that we actually provide, and then of course, like I said before, helps to substantiate why they're not collecting taxes from us, which is 30%. Well, under the new tax legislation that just passed, it's going to be coming down substantially, but still, even paying 20, 21, 25% tax is a lot compared to when you don't pay any. Okay, and last bullet there is bad debt losses. That's instances where individuals are determined to have some capacity to pay, but do not. And of course, no situation is perfect, so we make allowances for that and then adjust appropriately if that particular patient or that particular payer ends up making good on their obligation. Other revenue represents several of the issues that I spoke of before, the gift shop, parking structure, dining facility operations, but can also speak to issues of interest earned on investments, any sort of contributions that come into the organization from donors, as well as rental income and many others. These are just a few of the examples. Okay, so on the expense side, of course, we have multiple nuances and multiple areas of revenue, but on the expense side, can be equally as complicated, but even with the complications that we face in healthcare, can pretty easily be reduced into what we call both natural classifications as well as functional classifications. Okay, so depending on the reporting that's being done, you might see it a couple of different ways. A natural classification is, for example, all salaries across the entire organization. Okay, a functional classification is going to have it broken down by, like we say here, either inpatient services or outpatient services, or it might even be more granular than that, where we have a functional classification by pediatrics. So all the salaries within pediatrics, for example, that then, of course, need to be rolled up at some point to show all the salaries, wages, and benefits for the entire organization. So don't get confused as you look at different income statements. You might see them reported a couple of different ways. More often than not, then at least across the entire organization, you're going to see it at the natural classification level, but occasionally you might see it functional as well. So just be prepared for that. So as we drill a little bit further down, we're talking, from the reality of the healthcare industry, especially on the acute care level. Of course, this is variable depending on your healthcare setting. But at the acute care level, salaries and benefits, or you often will see it termed SWB, salaries, wages, and benefits, account for roughly 60 to 65% of the cost structure for most hospitals. Okay, depending on the organization, depending on the location in the country, depending on the service lines in question, size, affiliations with, if it's an HCA hospital versus a tenant hospital, there are going to be nuances, of course. But just know that when we start talking about the largest single source of expense, salaries, wages, and benefits are it. Second highest one in most instances is supplies. At least in my experience, roughly 20 to 25% of costs. Now, part of GAAP accounting, this is where a good example of where it comes into play. What we see actually expensed out on the income statement is the amount actually consumed versus how much was actually purchased. Okay, so what that means is, so let's say I order 3 cases or 3 pallet loads of IV solution. Okay, well, in the course of the reporting period, by the time I actually have to prepare the income statement, I've used one of those pallets, right? The other 2 pallets are carried in inventory on the balance sheet, okay, and are used or basically expensed out when they're actually put into use and actually in the process of healthcare delivery. Okay. So also important to know, we've talked elsewhere in this course about this topic of depreciation, right? So any long-lived asset is first what we call capitalized or recorded on the balance sheet as an asset of the business. This amount is then amortized or spread over the accounting life of the asset, which means it's just expensed out, like I say there in the second bullet. Okay, and we amortize that, or basically that process, if you will, that spreading process is what we call or refer to as depreciation. Okay, now again, if it didn't sink home in prior courses or prior modules, depreciation is a non-cash expense, right? It doesn't cost us anything. What it is the IRS and the other powers that be allowing us as an organization to reduce our taxable income by the amount of spread or the amount of basically proportional cost of all of our assets that we've acquired up to this point, so that we can take that excess capital that would otherwise be lost to taxes and reinvest it in the organization or set it aside so that we can repurchase or reprocure whatever asset that we're actually expensing off as part of our financial reporting process. Okay. Now, for financial accounting purposes, okay, for purposes of external reporting, often we're using depreciation calculated in one of two primary ways: either straight line, where you basically take the number of useful life or number of years of useful life of a piece of equipment and divide whatever the purchase price was by that number of years, so it's an equal number across the entire reporting period. Or we use makers, which I know you've been exposed to in other modules, that essentially allows us to expense more in the first, second years of equipment ownership, and then lets it trail off towards the end, so that we can turn that money around more quickly and set it aside or reinvest as needed. Most expense items listed on our income statement are only approximate. This is again based on accrual accounting. We're not always going to have direct clarity, but it's better than if we're using the cash accounting standpoint. Now, this is an area that's continuing to evolve, and I can share a couple of resources with you as we start talking about expensing. It's been discussed by several individuals, not the least of which are Harvard professors, Porter and others, that are talking about the benefits of activity-based costing. Not necessarily something we want to talk about when we're talking about financial reporting, but it's important for us to understand that as we start to move towards an era of more transparent pricing and providing our consumers the ability to basically go into any sort of healthcare delivery process with some sort of understanding of what it's actually going to cost them personally or cost their insurer. That's really going to require us to get much better at this issue of expensing, okay, and being able to really drill down into what it actually costs us to deliver a knee replacement or deliver a cabbage. And of course, there's nuances that, but again, not probably what we want to talk about here, but a topic of ongoing discussion that you need to be made aware of. And like I say in the second bullet here, again, amortization, depreciation is not a cash expense, okay? And we refer to that as a non-cash expense, and you will see that this concept, why I bring it up so often here, is we'll see this concept kind of trail along not only in the income statement and how we use depreciation to reduce our overall tax burden, but we also see it play out into the statement of cash flows and why we adjust for depreciation there, but that's a topic for a little bit later. Provision for bad debt expense, I kind of talked about this already, but we kind of have some sort of historical understanding of what bad debt has done or how it has performed or how much we've had to incur in the past. Okay, now this is something we need to watch and something that we can adjust for appropriately as we see basically the economy start to heat up and improve. Generally, we see our bad debt expense move in the opposite direction. Okay. Likewise, if we see an economic downturn, people start losing their jobs and they're going on to various forms of government assistance or simply aren't able to carry insurance. Of course, they get care rendered to them and oftentimes are not able to meet their obligations, and then we see bad debt expense ratchet up from where it was in prior periods. Okay. And last bullet here, interest expense, amount of interest paid or obligated on debt financing, as well as we might see, some of the other, in various forms of debt that we've talked about in other modules. Okay, so just to give us some clarity in terms of what this might look like from an income statement standpoint, this is a very simplified version of one. One big, basically set aside that we're doing right now is we're really focusing on, we talk about other revenue here, but generally you will often see basically operating revenues and non-operating revenues so that we can, again, gain some clarity with respect to how much of our income is being basically brought in from sources that are, our primary or our core mission versus not. But this is just here for the sake of kind of simplified reporting and understanding. So across the top, of course, more often than not, especially as you look at your an annual report for an organization, you will see 2 to 3 years, excuse me, oh, there we go, 2 to 3 years of financial reporting. So it's not unheard of to see 3. Generally, 3 is about the limit you're going to see, but a lot of times you'll see 2 as we're looking at here. So you have some sort of understanding of historical context as we went from the prior year to the more current one. And all we need to be able to do at this point is just start to diagnose, just from a, basically prima facie sort of perspective, or at first blush, really what sort of changes we've seen from 14 to 15. So we see a jump in net patient service revenue, so should be a good story, as well as a jump in other revenue, also good. However, we see a jump from 14 to 15 in salaries and benefits, in supplies, in insurance, in leases, in depreciation, in our provision for bad debts, and in our interest payments. Okay, so even though we saw this net patient service revenue jump, which is a good news story, we see a loss actually of net income. Even though we're still positive, right? Revenues still exceed expenses. It's at a lower amount than what we saw in 2014. Okay, so as we unpack that net income line, it's often a line you hear termed about the bottom line, or basically the excess of revenues over expenses. Number of different names for it, but ultimately it's our primary indicator of profitability for the reporting period. Okay. In not-for-profit businesses, though, you might hear net income called, again, this revenues over expenses, excess of revenues over expenses, change in net assets. At the end of the day, it really means the same thing. Is the organization making money? Okay. Now, also important to understand that there's a difference or a nuance between not-for-profit organizations and for-profit ones, right? Now, I want to stress, just because an organization is not-for-profit doesn't mean that it isn't interested in profitability, okay? They still, like the old saying goes, no margin, no mission. Well, it applies both for not-for-profits and for for-profits, okay? If the for-profit suddenly sees itself in a negative operating position multiple time periods, it's in as much of a difficult situation as any for-profit enterprise is, okay? But what the organization does with those profits very much differs between not-for-profits and for-profits. Okay, and that decision oftentimes is well, at least for the not-for-profit side, is dictated by being a 501c3. We will not see not-for-profits distribute profits to shareholders, right, or to anybody other than employees of the organization. Okay. All the proceeds from operations get plowed back into the organization to improve care, to expand operations, what have you. Okay, for-profits, though, can take any of those residual earnings and return them to the shareholders of the company. Okay, so if you're a shareholder of HCA, I'd have to actually look at this point whether HCA pays a dividend, but you can actually, as a shareholder, expect not only growth in terms of stock price appreciation, but you might actually receive a dividend payment from the profitability of the organization. Okay. Now, many of these organizations, especially healthcare entities, don't like to do that. It's bad PR to think that someone's profiting from someone else's, basically delivery of care. But there are exceptions, and there are a few that do. Okay. So basically the concept I want you to carry away, though, is for-profit organizations can take some portion of their income and return it in the form of a dividend. Anything that they don't can be reinvested back in the business, and that's where we get this concept or term plowback. It's literally plowed back into the organization, just like I talked about with the not-for-profit side. Okay. Now, it's also important to note that because we're following an accrual accounting standpoint, net income does not necessarily represent cash flow, because remember that net income, we've had depreciation taken out, right? which is a non-cash expense. It's basically an allowance, right? So in order to approximate how much cash flow that we have generated by the organization, we take our net income and basically add depreciation back in. And that's actually what we'll see transpire as we start to talk about the statement of cash flows. So with that, I'll leave you here at the end of the income statement. Our next video up will be the balance sheet.